imperial and paradox recorded for you. Yes. You'll be alive on arrival. It's so vital, giving tribute to the vision of those this life stifled. To win against the system like Christ's disciples, dying violently for denying.
This episode of the Visionary Experience. Today, in the solo cast, is just me, but we're going to be talking about a pretty important topic, and it's basically, why is credit so important? Why is credit so important? So let's just go ahead and dig in. So the term credit, the word credit, as defined by the dictionary, by Merriam-Webster dictionary, is the reliance on the truth or reality of something, financial or commercial trustworthiness, the provision of goods, money, or services with the expectation of a future payment. So that definitely makes sense. With regards to credit, it is the foundation that we really need to have a very firm grasp on. Credit history, by and large, is a prediction of future performance. Okay. Your credit history is a prediction of future performance. Payment history is your future payment history. Okay. It's basically saying that, look, what you did in the past most likely is going to be replicated in the future. Not always, definitely, because so many people turn their lives around and so many people change and they improve. But by and large, that's how it's viewed. Okay. So a person is not a credit score. Let me make that clear as we get into this. I don't believe that at all. I believe that when you are looking at someone's credit history, the numbers really do tell a story. You can see a narrative of different things that may have occurred in someone's life at some point in time, whether it be something personal, professional, health-wise. You can actually physically see that. And, by and large, that's exactly what happened. But we have to learn to play by the rules of the game. And that's the bottom line. If you want to qualify for number one, if you want to qualify, period. But if you also want to qualify for the best terms of purchasing a home or getting an automobile or anything like that, then you have to learn to play by the current rules. Now, the rules change regularly, but a lot of the basics of those rules don't change. And it's important to understand that banks primarily lend based on one word only, just one word. And that word is risk. Okay. Which actually happens to be my favorite board game. A lot of people think it's boring. I love it. So shout out to the board game Risk. But I also love Monopoly for sure. So here, let me give you some examples with regards to risk. A bad payment history is indicated by 30-day late payments, 30-day plus late payments on a credit report, definitely within the last 12 to 24 months. Okay. Multiple items in a collection status for whatever that reason is in a collection status, maybe some high balances on credit cards, that type of thing. That's not the best credit history to have. And I can promise you it would definitely be reflective in your score. Okay. All of these things point to high risk. Okay. A good payment history or, a good credit landscape is more indicated by the complete opposite. Everything's paid on time, no collections, no credit cards with high balances, but you have, credit cards with low balances, and you have a good balance. You have a good mixture. And what do I mean by that? So you may have anywhere between 1 to 3 credit cards that you are using that are open and active, that you're maintaining low balances on, meaning the conventional wisdom is 30% or less. I would probably say 20% or less utilization. So for example, if your limit is $1,000, then you want to keep that balance at $200 or less per month. And another thing that I would highly advise people to do is auto pay. And so this way, if you have a low balance, then the minimum payment's not going to break the bank. Okay. And what having auto pay also avoids you losing the statement, the mail not coming, the dog eating it, some kind of excuse that you've now made a 30-day late payment and it's hit your credit and dropped your score 30 points. So now you can at least know that the payment is automatically going to come out every month. And that is definitely working to your in, your advantage. Now, when I say the word risk, what do I mean risk? Risk of what, right? Well, the word is default, okay? The banks don't want to take a risk that you're not going to pay them back, okay? They don't want to have a high risk that your mortgage is going to go into foreclosure, because that leads to loss. That leads to loss. Well, let's explain why and how it leads to loss. So let me use a pretty simple example. If you go out and you buy a $200,000 townhome, okay, and let's say your mortgage on that $200,000 townhome is, I don't even know, let's say about $190,000, okay? So you may have that home for a year or two, but remember the first years of your mortgage, you're paying primarily interest. Okay, and that's a whole different topic. But let's say after the first couple of years, that balance is only gone down to maybe 185,500 or 188,000 or something like that. Okay. Well, if something happens and you end up not being able to make the mortgage payments, you end up going into a foreclosure situation. Well, the bank has to look at what the market value of your home is versus what you owe them. And if there's not a big difference there, ultimately, the bank, the bank foreclosing is going to lose money, because they have to pay realtors fees, they have to pay attorneys fees, they have to pay state and county fees, all kinds of stuff, which eat away at that difference between whatever that house is worth and how much you owe them on the mortgage that you got. So that's why they try to avoid that situation in the first place. I think there's a myth, by and large, I wouldn't say in all cases, but there's a myth that, that lenders want to take homes back from people. And I just really don't think that that's true in most situations, because it's much more, they have to put it in front of some kind of internal asset manager and this and that. Now, look, if there's a lot of equity in your home, right, then they're not only going to get themselves repaid, but they're also going to then have that difference of equity, which is a premium for them. So I'm not going to say in all cases, for sure. But again, banks are not in the business of lending money to lose money, right? I mean, it makes sense. Okay. So they need to take whatever measures possible to reduce the possibility of a person who's borrowing money won't pay them back. I mean, it's simple common sense. It's simple common sense. So, think about it. Let's use a higher example. If someone's, buying a $300,000, $400,000, $500,000 property, the bank really should have the right and the responsibility to mitigate their risk. That's why people say, wow, well, I've given them all information. I got to give them a sample of blood. Okay. That's taking it a bit too far. But again, if you're borrowing that much money, right? Why shouldn't the bank want to make 100% sure and do their due diligence to cover all the bases to know that you are a low risk of default? Okay. So, I mean, it just makes common sense. And so I think what we have to do, honestly, as mortgage professionals and finance professionals, is be able to communicate that clearly with our clients, not in a non-empathetic or robotic way, because then it just makes people frustrated. They don't understand. They don't understand the why. It makes them angry. And sometimes people just want to pull the plug and say, forget it, bag it. I just don't want to do this. But when you are able to clearly communicate with a client or clients why we need certain pieces of documentation, I can tell you that most times they're like, okay, now I understand why you need what you need. And so they will go ahead and do their best to provide it. You want to be able to communicate in an efficient way as well. And what do I mean by that? You don't want to just every 3 or 4 days, you're calling someone to ask for more stuff. You don't want to send them texts and emails, because I would be annoyed too. Try to front load it. So that takes diligence. It takes experience. And it takes the proper analysis on each and every loan, because each and every loan has a different situation. So what that client's loan landscape is going to look like. What their income and assets are going to look like. You know what type of program they're going to go into. So you ask for the majority of the documents up front, and you front load it so that, again, the client experiences a good experience, and they're giving you most of what's needed up front, and they're not being annoyed as you go throughout, you go out throughout the process. So, let's say let's say you lend some money to a friend, a good friend, and, you do it a couple of times because they're really in need. Of course you're going to do that. You're a friend. No question. No question. However, they come to you again at some point and, really in need. And you're like, look, brother, sister, you're not going to pay me back. So, you at some point you have to make a decision on what you're going to do. Okay. If that person does not have a history of paying you back, then that's, even if it's a good close friend, you giving them money is going to call into question, right? But let's say on the other hand, you have someone who is reliable. Let's say my podcast engineer, Anton, right? He's like, what? You're putting me on blast. And let's say he has an example, he has a past history of paying you back. Well, he's good for it, right? He's good for it, right? Well, then you don't have as much hesitation, in being able to loan that person money if they didn't, if they asked for it. And remember, truth be told, the Bible has taught this lesson for at least 2,000 years. It's in Luke chapter 16, verse 10. Please look it up. If you're faithful to the small things, then you will be faithful in the larger things and in the bigger opportunities. So let's explore this a little bit more. Credit is a foundation. Okay. Credit is a foundation that you're building upon, right? And remember, credit worthiness is not just what's on your credit report. It's holistic. It's the totality. What do I mean by that? Your income, your assets. How much money do you have in the bank? How much money do you have in a 401k, a TSP, mutual fund, something like that? Your employment history. How long have you been on the current job? How long have you been in the current industry? Do you have a history of bouncing around from job to job and you're not there for very long? It's unstable. How is your rental or housing history? Does it need to be verified that if you've been paying rent, okay, have you been paying rent on time and not late? Because again, that's a very big indicator on what would potentially happen in the future. That all is combined to create what's called your credit worthiness. Okay. Now, income is a very important term in lending. And that's the first thing that I had mentioned with regards to your credit worthiness, because it plays the biggest part in traditional loans here, right? With regards to you qualifying for a loan, period. Income plays the biggest part. And it means there's a term in lending today that's called ATR, Apple, Terry, Richard. Okay. And it's the ability to repay. Because if you don't have sufficient income, then how do you have the ability to repay the loan? And so there's certain, formulas that we use to quickly ascertain that. The term assets that I mentioned before. Okay. Assets. Do you have money that is liquid? Well, what does liquid mean? It means that you can quickly get it in hand. Okay. Money that is readily accessible in case it is needed to repay whatever. Okay. Job history. Okay. Your employment, your source of income. Here are very important bullet points that you have to remember that the bank is going to look at closely with regards to your job history and your employment. Numero uno, is it reliable? Is it reliable? Are you W-2? Are you 1099? Are you self-employed? What's that industry like? Has your income over the last couple of years been increasing, or has your income decreased? That is extremely important. Is it stable? Is it continuing? Okay, let's stay on continuing for a minute. We often get things called verifications of employment. And so there's a box that's on that particular form that says, okay, what's the likelihood of this person's employment continuing? And they have to check on, either yes, no. They can put a note in there. Yes, it's very likely. Why is that important? Because they want to know, are you going to continue to get paid? Okay. I just mentioned, before, is your income increasing or decreasing? Now, your income can decrease from one year to another, but there could be very good explanations for that. Maybe as a woman, you were on maternity leave, unpaid, or maybe as an individual, you had, unfortunately, some type of a health issue which caused you to be out of work for a while, or maybe you had to take some time off to take care of a family member or something important. There are ways to explain those things that make common sense, because underwriters still underwrite according to common sense. They just want to know that, okay, well, all other things being equal, you are either making the same amount of money or you're getting a little bit of a bump up every year, which helps them to have confidence in your income. And finally, over all of these things, is it documentable? You have to be able to document and verify all of your income. So if you're a W-2 employee, you work for a company, you work for the federal government, something like that, contractor. Well, the W-2, the pay stubs are, documentation which prove that you work there, followed up with a either verbal verification done directly by the bank, calling the employer, or a written verification that you can either get that's automated, or we may call the human resources department to verify that what you actually make and show on your W-2s and pay stubs is actually what they have in the books. Okay. Those things have to match up. Okay. So really, those things that I mentioned are all about the credit worthiness, being able to receive a loan in exchange for the collateral, right? What's the collateral? The property that you are purchasing. Okay. So, that is really important. Now, here's the deal. Some of you all may know that I have actually taught Financial Peace University to my church for the past few years. And I really love being able to do that. And there's a segment of the population that really that follows Dave Ramsey, for sure. And that segment of the population, they don't believe in credit scores. Okay. And I have something to say about that, and I really do understand. And in fact, I actually deeply respect that philosophy. So let me be clear with that. Furthermore, before I keep going, there is a biblical precedent about not being slave to a lender. Okay. However, I believe that the context that is being forced, about being forced into a situation and then being beholden to a lender, that's what we need to talk about, because we have to talk about context here. And I think that is the biblical context that's going on here. When you are applying for a loan, you're not being forced. You're not, because remember, if someone's a slave, you just don't voluntarily enter slavery. So I think we have to look at when we look at the Bible, we look at anyone that's using biblical scriptures, you have to make sure that it is in context, so you're not misled. Getting into a loan to buy a house is voluntary, and you understand the terms. Okay. It's voluntary. So you understand the terms. There's a whole bunch of papers and estimates and things you got to read and sign and understand. All right. That's why banks look at what's called your debt to income ratio. How much money are you making? Okay. Versus what debt are you going to be bringing to the table? Okay. For this very reason, they want to make sure that you're not in over your head, and that you have residual funds and margin to comfortably repay your loan. That not only helps them, but it helps you, as well. So let's not lose sight of that. Now, if you're going to go out and buy a house, fantastic, great. Give us a call here at Visionary Lending. Congratulations. Now we will help you get a mortgage. However, that's cool, great. But think about this. If you then go out and get a new car, or you go on some type of a lavish vacation, or if you go out and buy a bunch of $1,000 suits or whatever it is, you're going to go in more debt. You may go into more debt for another reason. Now you have a problem, because you have put yourself in a situation where your ability to repay is severely impacted and compromised. So it is extremely important to be financially responsible. Okay. And that's kind of a gray area value, to be very honest with you, because different people have different understandings and different interpretations and definitions of what financial responsibility is. But I would say the overarching perspective would be, okay, let me pay all of my debts on time. and let me make sure that every month I'm able to sleep, and pay my bills, put a little bit of money aside, put food on the table. If you have some basic foundations laid down, then you can set yourself up, for sure. And again, we've been talking about having common sense, throughout the podcast. And again, I'm not trying to put anybody down, not trying to talk over or above anyone, but really a lot of financial management honestly is about common sense. And in fact, I was just reading about annuities last night, just learning, reading about it. And the author of what I was reading was saying that, so many annuities and financial products have these big, thick prospectuses and all of these different addendums and riders. And the author, she said, look, if what you're reading is just simply too difficult for you to understand, it's just too much jargon, then you probably need to find something that's simpler. And I agree 100%. The same concept goes if you're investing in anything. I've read and I've heard from various different sources, do not invest in a company where you don't know what their business is. You don't know what their business model is. You don't even know what they do. You're not setting yourself up, for success because you haven't done the proper research and you really don't even understand what they do. So I would definitely go back to that for sure. So let's go back and continue to clarify my comments I made about financial peace. I've taught that, course again for a few years, and it's definitely been a blessing, and I'm 100% on board with it. Okay. However, with me being a mortgage broker, being a practitioner, with boots on the ground every single day in the mortgage industry for 10, 15 plus years, I also know that 99% of the country just does not have 20% down, hanging out in their back pocket or in some secret briefcase to put down on a home. They just don't, unless it's a tiny house. Unless you're buying a tiny house, maybe you do. But unfortunately, and again, I say unfortunately, people just don't have that money just readily available in their savings, gift, whatever, but you do have people who espouse and teach, well, you need to have 20% down. Well, then if you don't, then you just need to go ahead and save until you get it. Well, then people will be saving for years upon years upon years. That's why you have mortgage innovations today that allow people to put down either nothing, for down payment assistance, and I have my thoughts on that as well, but either 3% down, 5% down, that's a far more realistic amount of money to put down. Okay. Now, some people will say, well, Brandon's not talking about, PMI. What about PMI? You know what? I did a whole video on my YouTube channel about debunking myths on PMI. Okay. So check out that video on my YouTube channel and then kind of come to me, put some comments there, and then we can talk about that for sure. Again, you can purchase a home with a smaller down payment, do what's called a bi-weekly payment on your mortgage or make extra payments. And then you can accelerate the amortization. You can accelerate the calculation of your mortgage payment mathematically if you stick with it and cut off a lot of time of your mortgage and pay off a lot of the principal and interest much more quickly. It's the reverse snowball effect where you have the credit cards that go up. Well, as Dave Ramsey also teaches, giving him a shout out again, that, you have the snowball effect where you can pay off things more quickly. So again, part of my job is to help people embrace reality. Okay. Embrace reality. And when you embrace reality of, okay, I want to purchase this home. We want to change our lives. We need more space for our family. We're going to start a family. I need to take care of a family member. I need to just get in a better neighborhood. I need to feel safer. I need to have a better community. I want a backyard, whatever it is. Okay. The house is the end result. We are here to help you and to educate you and to guide you along your journey to get there. We are not here to judge or to point fingers or to do anything of that nature. But no, we're actually here to walk hand in hand, side by side, so that we can help you to achieve your goals. But we also, I feel in my heart that we also have the responsibility to educate and to teach properly, not anything leaning toward what we do one way or the other, but to put the facts out there, to put the information out there so that you can research it yourself, so that you can have your own understanding and your own confidence in this. So I really hope that this podcast was very helpful to you. If there's anything that you want us to continue to talk about, please reach out to us. Our website is www.visionarylending.net. Please go to any of our social media platforms. We're here to connect. We're here to educate, definitely here to empower. Those are not cliche terms, but we really connect with our clients. Look forward to talking to you later. Thank you so much for checking out this podcast on why is credit so important on the Visionary Experience. Hey family, what an amazing conversation today. I look forward to seeing you again soon, and as always, to God be the glory.